Okay, so exam 3 has 3 chapters, chapter 7, 8, and 9. 2 questions from chapter 7, 2 questions from chapter 8, then 1 question from chapter 9. Each of the problems is worth 20 points, just like the rest of the exams that you've had so far. As you can tell from the homework, chapter 7 and chapter 9 are probably the 2 hardest chapters in the textbook. So definitely incorporate lots of practice into it. But after today and after Monday's class, you'll know exactly what you're going to be tested on. So you know exactly what to practice. The first problem from chapter 7 that we're going to go through is exercise 726A. And this is calculating depreciation expense using the 3 methods that we talked about in class: straight line, units of production, and then double declining balance. So what I've done is I've written it out in words, the calculations, so that you're used to seeing what it is. We're going to identify certain pieces of information. I think that it is helpful as you're practicing to maybe print out problems and label things, but that's just me. Practice, that's key. So Presley Pizza bought a used Ford delivery van on January 2nd, 2018. So something to note there is the date the asset was placed in service, right? The beginning of 2018. So that means in year 1, we'll take a full year of depreciation. Dates are very important in this chapter. They paid $22,000 for that used delivery van. What is the $22,000 called? Cost.
The cost.
Yep, the cost basis of that asset. The van was expected to remain in service for 4 years, which is the equivalent of 80,000 miles. What is that considered? The useful life, right? Yep, thank you, Sasha. At the end of its useful life, Presley management estimated the van's residual value would be $2,000. So they gave you what that is. Salvage value, right? How much we expect that we can sell it for at the end of the useful life. For this next portion, the van traveled 32,000 miles for the first year, 28,000 miles for the second year, 15,000 for the third, and 5,000 in the fourth year. What do we know we're going to use this set of information for? Which method?
For the units of production depreciation.
Correct. So this is the actual activity for units of production. All the rest of the methods, we basically ignore it. Okay, so requirement 1, prepare a schedule of depreciation expense per year for the van under the 3 methods discussed in this chapter. And it does tell you what to round it to, so pay attention to that. So it says 2 decimal places after each step of the calculation. We'll answer questions 2 and 3 after we go through the calculations. So we'll start with straight line because I think it's the easiest one to calculate, and most of you will agree with me on that. I think all of you will agree with me on that. Straight line is calculating the same amount of depreciation in each of the years. And the calculation for annual depreciation expense is the cost of the asset minus residual value. And when we take cost minus residual value, we call that what? Depreciable cost.
Oh,
So this is the amount of the asset's value that we're actually going to depreciate, divided by the useful life in years.
Wait, something's going on.
So cost of this asset is $22,000, right? How much do we expect to sell this asset for at the end of the useful life? What's the salvage value?
$2,000.
2,000. So we're subtracting that out because we know we're not going to depreciate that asset for that amount. Divided by the useful life in years. The useful life in years is what?
4 years.
4 years. So I will calculate the depreciable cost, 20,000. So that's the amount of the asset that we're actually going to depreciate, divided by 4 years. So each year we're going to have what amount as depreciation expense?
Okay.
$5,000.
5,000 per year. So if they have a table that you have to fill out, which I think they do, which is kind of ridiculous for straight line. 5,000 would be the amount that you're recording for depreciation expense at 12/31/2018. 5,000 would be the amount of depreciation expense for 2019. 5,000 for 2020, and then 5,000 for 2021. So over the useful life, over those 4 years, the total amount, and this, they're not asking for this, but when you sum up these 4 years worth of depreciation expense, it equals $20,000, which is depreciable cost. Each year is the same amount because you use the asset for an entire year for each of those years. Questions on straight line before we jump into units of production?
No.
Feel confident with that one?
Yeah.
Yes.
Okay, good. That's what I like to hear. For units of production, this is a method that we use when an asset depreciates based on usage. So we're only going to depreciate the asset when we use the asset. If we don't use the asset during a particular year, then we're not going to have any depreciation expense recorded. There's 2 portions of the calculation. The first portion of the calculation is that we need to calculate depreciation expense per unit. And in this case, because we're talking about a van, it's going to be the depreciation expense per mile that we drive. The calculation looks pretty similar to what we did before. Depreciation expense per unit is the cost basis of the asset minus residual value divided by the useful life in year, or sorry, the useful life in units. In this case, in miles.
80,000 miles.
So 22,000 is the cost again, minus 2,000 residual value, divided by a useful life of 80,000 miles.
0.25.
So depreciation expense per mile is going to be 25 cents per mile. I'll give you a second to write out the table below. You don't need the table necessarily because you just need to calculate it, but I think it is helpful. When you're calculating annual depreciation expense, which is recorded at the end of each year, so 12/31, 2018, 2019, 2020, and 2021, you're going to take your depreciation expense per unit, which you just calculated, and we're going to include next to it in column B the actual activity for that year. So how many miles they actually drive during each of those years. And we're going to multiply our depreciation expense per unit times the actual activity to calculate depreciation expense each year. So I'll give you a minute to write the table down. And in column A, I'm just going to incorporate the 25 cents per mile, which we already calculated. For the actual activity, you go up to that portion where we said actual activity, we labeled it before. In year one, the van traveled 32,000 miles. In year two, the van traveled 28,000 miles. In year three, 15,000 miles. And then in year four, 5,000 miles. So in your mind, you know that year one is going to have the most amount of depreciation expense taken. So it's kind of a reasonableness check for you. And to calculate annual depreciation expense, you're going to multiply columns A and B, the depreciation expense per unit times the actual activity. Is everybody with me?
Yes.
Okay. So in year one, what is 25 cents per mile times 32,000 miles?
8,000.
8,000. So depreciation expense is going to be $8,000 in year one. In year two, we're going to have slightly less depreciation expense because we drove 4,000 less miles. So in year two, how much is depreciation expense?
7,000.
7,000. In year three, you drove 15,000 miles, so substantially less, times 25 cents per mile. What is your depreciation expense?
3,750.
3,750. And in that final year, you drove the fewest miles. 25 cents per mile times 5,000 miles gives you a depreciation expense of what?
1250.
1,250. Correct. So in total, if I added this up, the accumulated depreciation balance at 12/31, 2021 would be equal to what?
20,000.
20,000, which is depreciable cost. So we know that's correct. The asset is fully depreciated at the end of 4 years because they went through those 80,000 miles in those 4 years. So with each of the methods in total, you're going to depreciate that asset $20,000. Depreciation expense each year is going to be different depending on the method used.
Can you scroll down
Any-
slightly?
What was that?
Can you scroll down slightly?
Yes. Thank you for reminding me.
Professor Wade, on this method, are we going to need to calculate the accumulated depreciation and the book value, or just the annual depreciation?
No, this question is only having you calculate annual depreciation expense.
And what about in the test? We're going to calculate the whole steps?
Yeah,
to the
it
book
seems
value, or
it does seem that at the bottom it is having you show that. So I will show it for straight line because I don't want you to miss any points. So it's just showing I don't necessarily think it's going to have you label it as accumulated depreciation balance at the end of the useful life, but it is showing that the total of all depreciation expense taken on the asset equals 20,000, regardless of the method. Questions on either of those first two methods? Or is it pretty straightforward?
does the residual value is the same meaning of salvage value?
Correct. Residual value,
Okay.
scrap value, salvage value, they're the same meaning. Okay, for double declining balance. This is the more complicated one. It's the only method that we ignore residual value until the final year. It's an accelerated method of depreciating the asset. The first thing that you're going to do is calculate the double declining balance rate. The double declining balance rate is 2 times the straight line rate. Straight line rate is not used for straight line. Remember that. The straight line rate is 1 divided by the useful life in years. So first thing we're going to do is calculate the straight line rate. So 2 times 1 divided by 4 years useful life. So when we're using straight line, we would calculate and take 25% depreciation expense of the depreciable cost each year times 2. So the double declining balance rate is 50%.
50%.
Can I just take 2 times 5,000? No. Because the 5,000 was calculated netting out residual value for straight line. For double declining balance, we ignore residual value until the final year of depreciation, and we use it to back into depreciation expense for the final year. So what we're going to do is take our double declining balance rate of 50%, and we're going to multiply that times our book value, the beginning book value for each period. And that's how we're going to calculate depreciation expense per year. I'm going to use the chart because I do think it is useful. The date, The first date that we're going to depreciate this asset is 12/31/2018, right? At the end of 2018, the beginning book value is the next column, and I've labeled it A. In column B, you have depreciation expense per year. In column C, you have your accumulated depreciation balance. It initially starts at 0, and then every year that we record depreciation expense, it increases by that depreciation expense. The final column is our ending book value. So at the end of that year, after you record depreciation expense, what's the book value? And it's going to take column A, which is your beginning book value, minus depreciation expense for the period. Your ending book value becomes your beginning book value for the following year. Give you a second to write this down. So I did a little calculation off to the side for you for book value. Remember that one way of calculating book value is taking your cost of your asset minus the accumulated depreciation balance to get the book value. Over the useful life, the accumulated depreciation balance is increasing. And over the useful life, the book value of the asset is decreasing, right? At the end of the useful life, book value will equal residual value or salvage value. The asset was placed in service on January 2nd, 2018. What was the cost basis of this asset?
$22,000.
$22,000. When you place this asset in service on January 2nd, 2018, how much is the accumulated depreciation balance? Have you used this asset at all? No.
Column C or which one?
No. January 2nd is the date that you place the asset in service.
Yes. Yes.
So you haven't used this asset at all. So you have no depreciation expense on this asset at all. So your accumulated depreciation balance as of January 2nd, 2018, the beginning of year 1, is 0. So your book value, your beginning book value, is exactly equal to cost. So we always start with the cost basis of the asset as our beginning book value. $22,000. You haven't used the asset yet. It hasn't been depreciated. So you start with your cost. Depreciation expense in year 1, you're going to take beginning book value of $22,000 times our double declining balance rate, which is 50%. And year one's depreciation expense will be the highest that you will report, $11,000, which is what we're going to include in column B. When we record depreciation expense, we debit depreciation expense, credit accumulated depreciation. We started with an accumulated depreciation balance of 0 plus 11,000 for year one's depreciation. So our accumulated depreciation balance becomes $11,000. In year one, column B and column C will always be the same number. Ending book value, we're going to take our beginning book value of 22,000 minus depreciation expense for the year of 11,000. So ending book value becomes 11,000. Put an asterisk by that. The only reason why this number is the same as depreciation expense and accumulated depreciation for that first year is because of the 50% double declining balance rate that we're using. If you have a rate that is different than 50%, do not expect this number to be the same. 22 minus 11 is how we're getting that number. The ending book value for year one becomes the beginning book value for year two. So at 12/31/2019, we have a beginning book value of 11,000. So we need to calculate depreciation expense for 2019. 11,000 times our 50% double declining balance rate gives us
5,500.
5,500 in depreciation expense for year two. So substantially lower, which is what would be expected for double declining balance, because it is an accelerated method of depreciating an asset. Over time, our accumulated depreciation balance, remember, is increasing. Beginning book value for the year would, or I'm sorry, beginning accumulated depreciation balance for the year would be 11,000 plus depreciation expense for the period of 5,500. Our ending accumulated depreciation balance is what?
16,500.
16,500, correct. The ending book value
5,500.
is 11,000 minus 5,500, 5,500. Again, do not expect this number to equal depreciation expense if you don't have a 50% double declining balance rate. At 12/31/20, year three, my ending book value from year two becomes my beginning book value for year three. 5,500 is going to be used to calculate depreciation expense. So are you required on your test to do this entire chart? No. But if you don't calculate the ending book value each year, you won't correctly calculate depreciation expense. So that's why the chart comes in handy. 50% of the beginning book value of 5,500, how much is depreciation expense in year three?
2,750.
2,750, correct. The accumulated depreciation balance increases by this amount. What is my new accumulated depreciation balance?
$9,250.
19,250, correct. So are we still below our depreciable cost? Because
Yes.
remember that our ending accumulated depreciation balance needs to equal depreciable
2,000.
cost. So we're still below, we're still fine. We know this is not the final year of depreciation for this asset. Beginning book value minus depreciation expense for the year gives us our ending book value, 2,750. $12/31/2021. I'm going to carry down that 2,750. And that becomes my beginning book value. $2,750 times 50% gives me depreciation expense of what?
1375.
1,375. And then when I add in accumulated depreciation, sorry, beginning balance of accumulated depreciation plus the depreciation expense for the period, what is my balance of accumulated depreciation?
20,625, which is over the cost.
The 20,625, which is over my depreciable cost. I'll just highlight that. Ending book value would become what?
Less than 2,000.
So 1,375, right?
Yeah.
Right now, I did this on purpose. This is not correct. I'm going to cross off this row, those last three numbers. Every method will be fully depreciated by the end of 4 years, the useful life. This is the final year of depreciation expense. I know that I have to plug this last number because if I was to continue on using the 50% rate, I would have over depreciated that asset. The accumulated depreciation balance for this asset needs to equal depreciable cost of $20,000, just like all the rest of the methods. Double declining balance ignores salvage value until the final year. We plug depreciation expense, meaning we back into depreciation expense by taking into account that salvage value in the final year. So there's two ways of calculating it. And I'm actually just going to go like this and continue my chart below. So 12/31/2020, you still would have a beginning book value of 2,750. But depreciation expense will be different, accumulated depreciation, and then the ending book value will be different.
Would it be 2020 or 2021?
2020.
2021, I wrote it wrong. Thank you. Keeping you sharp, because clearly my brain is not sharp. Sorry.
You're all good.
Okay, for calculating that final year of depreciation expense, you can use the book value method, or sorry, accumulated depreciation method or the book value method to get it. So for the accumulated depreciation, you're going to go with ending accumulated depreciation balance, what it should be, which it should equal depreciable cost, which is cost minus residual value or salvage value. 22,000 minus 2,000. So depreciable cost in this case is $20,000. Minus what we already have as our accumulated depreciation balance, what our balance is at the beginning of 2021, which is the end of 2020, 19,250. So depreciation expense in year 4 should be equal to what?
750.
Correct, $750. If I was taking the book value method, we're comparing the beginning book value, which is 2,750, to the ending book value, what it should equal. $22,000 minus $20,000, right? Depreciable cost. So the ending book value should equal 2,000, which is our residual value or salvage value. So 2,750 minus 2,000 gives us depreciation expense in year 4, $750. So both of those numbers work. It's the same. $2,750 minus $750 gives us accumulated depreciation. Sorry. $750 plus $19,250 gives us accumulated depreciation balance of $20,000. $2,750 minus $750 gives us an ending book value equal to salvage value of $2,000. So we know this asset is correctly depreciated. Questions? Just slow down as you reach the end of the useful life on double declining balance. Think about the total that accumulated depreciation needs to be. Think about what the ending book value needs to be. And don't just go, oh, we did it the same way last year, so this is the same way we're going to do it this year. Think it through at every step of the process. You know, double declining balance is going to be the hardest one. So take more time to practice it, write out the steps, think about the calculations, ask questions. And writing it out in words is always helpful. At least it is for me. Do you guys want to move on to another problem, or do you want to take a quick break?
A quick break.
Okay, that's what I thought. Okay, we'll take a 10-minute break here. Questions on this before we go?
No, can you just stay on this page for a minute?
Oh, of course, Angela, I'll stay on here. Okay, so I will pause the recording. Okay, for that last problem, I forgot to mention the answers to part 2 and 3. So the first question was asking you the best method for tracking wear and tear of the assets over the useful life, which is going to be units of production. And then the last question asked the best method for tax purposes, income tax purposes, which would be double declining balance. because you're taking more depreciation expense earlier in the useful life. For problem 2, this is also from chapter 7, and it's the sale of a fixed asset. So we're going to work on exercise 730A, exercise 7-31A, exercise 7-44B, and exercise 745B would also be equivalent problems to practice or similar problems. On January 2nd, 2018, Ellett Furniture purchased display shelving for $8,900 cash, expecting the shelves to remain in service for 5 years. So January 2nd, 2018 is the date the assets are placed in service. The $8,900 is our cost basis of these assets. So in that fixtures account on January 2nd, 2018, they would debit that account for $8,900 for the cost. Remember, that's an asset account. And I'm just establishing that T account because it'll just remind us when we record the sale. The expected useful life was 5 years. Which we're going to need for later. Ellett depreciated the shelving on a double declining balance basis. So we get to practice that again with $1,100 estimated residual value. On August 31st, 2019, the company sold the shelving for $2,800 cash. So August 31st, 2019 is the date of the sale. And is this asset fully depreciated? Has it reached the end of the useful life?
No.
Not even close, right? They used it all of 2018 and then part of 2019. The $2,800 cash is the proceeds from the sale of that shelf. Record both the depreciation expense on the shelving for 2019 and its sale in August. Also show how to compute the gain or loss on the disposal of the shelving. So, first things first, we can't just jump into the journal entry because when you're using double declining balance, you need to calculate the ending book value from year 1 to calculate depreciation expense for year 2, or the partial year depreciation expense for year 2. So we're going to write out our table again. And the first date we're going to have is the end of year 1, December 31st, 2018. The good news is that they placed the asset in service at the beginning of 2018. So that first year, you're taking a full year's worth of depreciation expense. For the beginning book value, we always start with the cost basis, right? In year 1. So $8,900 is the cost basis of that asset. we need to calculate our double declining balance rate, which is 2 times the straight line rate. So 2 times 1 divided by the useful life in years. What is the useful life in years for this asset?
5.
5 years.
5 years.
5 years. So 2 times 20%, right? What is my double declining balance rate?
40%.
40%. So year 1 depreciation expense, book value, beginning book value of 8,900 times our double declining balance rate of 40%. So year 1's depreciation expense is equal to what dollar amount?
$3,560.
Yep, 3,560. That's a 5, sorry. The accumulated depreciation balance is going to be the same as depreciation expense in year 1. So 3,560, right? And I will include it over here. Remember, this is a contra asset account. So it has a normal credit balance. So the balance at 12/31/2018 is 3,560. The ending book value is the difference between the beginning book value, depreciation expense for that period. So 8,900 minus 3,560 gives me an ending book value of what?
$5,440.
Yeah, 5,440. For the next year, what is the date we're going to use in this table? Am I going to use 12/31/2019?
No.
No.
August 31st.
We didn't use the asset for the entire year. We used it for part of the year. So we're going to use our disposal date, August 31st, 2019. This is the date of our sale. Our ending book value from year 1 becomes our beginning book value for year 2, right? 5,440. Because we're using the double declining balance method, we had to calculate year 1's depreciation expense.
I'm pretty sure ending book value is actually
I'm
53.
double checking it. I just
Oh,
saw.
okay. Okay.
Correct. It is 5,340. Sorry. For the beginning book value, it's equal to the ending book value, 5,340. We need to first calculate what the annual depreciation expense would be for the method. 5,340 times 40%, which is the double declining balance rate. Annual depreciation expense would equal what?
$2,136.
2,136. We didn't use this asset for an entire year. We used it for a fraction of the year, from January 1st, 2019 until August 31st, 2019. So I did a little calendar at the bottom, right? This is for year 2, because we're going to need to know how many months we use the asset in year 2 in order to calculate book value, or calculate depreciation expense as well as book value. So we used it from January 1st until the end of August. 8 full months worth of depreciation expense is what we need to calculate. So when you're calculating a partial period worth of depreciation expense, you're going to calculate your annual depreciation expense first, which we did, $2,136. And then you're going to take a little calculation, the number of months that you use the asset during the current period divided by 12 months per year. So we're going to multiply this times 8 months divided by 12 months to get that fraction of a year that we use the asset. And 2019 depreciation expense is what dollar amount?
$14.24.
Yep, 1,424. If you keep getting depreciation expense wrong, double check your ending book value from last period. Double check the number of months that you're using. It's likely one of those two things that's the reason for it. We'll finish out the chart here because we're going to need it for later. What is my accumulated depreciation balance become?
$49.84.
4,984, right? Because we add in that final period's depreciation expense, 1,424 on August 31st, 2019. When we add those two up, it equals 4,984. The ending book value, 5,340 minus 1,424 gives us an ending book value on the date of disposal of what?
$3,916.
3,916. On August 31st, 2019, we need to record depreciation expense, final year's worth of depreciation expense. We're going to debit depreciation expense for those 8 months worth of depreciation, or 8 months worth of usage of that asset, for 1,424. And we're going to credit accumulated depreciation what we already show in the T account, increasing accumulated depreciation for 1,424. So we recorded that final period's depreciation expense. You also need to record the sale in August. Part of showing this, recording the sale, is that they want you to calculate and show how you calculate the gain or loss on sale. So the gain or loss on sale is determined based on the ending book value of the asset compared to the cash proceeds. So we receive how much cash?
800.
$2,800 in cash is coming in. The ending book value for the asset, the date of disposal, is $3,916. Our ending book value is greater than the cash proceeds that we receive, meaning that the asset's value to our books is greater than how much we sell it for. So we're going to report a
Loss.
loss on sale equal to the difference, 3,916 minus 2,800 in proceeds. What amount is my loss?
1,160.
1,160.
116.
160.
Correct. So when we're recording the sale, at a minimum, you're always going to have, when you have cash proceeds, at least 2 debits and at least 1 credit. So I'm going to write 2 debits, skip a space, and write a credit. The first debit is the cash proceeds, right? Don't forget that. We receive cash, so we're going to debit cash, increasing cash for the amount that we received, $2,800. The second debit is going to be to what account? What account needs to close with a debit? If you sell your asset, you no longer have the asset, and you need to
Asset,
also remove the accumulated depreciation of that asset. So we're going to debit accumulated depreciation for the balance. Closing out that account for $4,984. So after we record that, the account closes to 0. You no longer own those fixtures, so you should no longer have the accumulated depreciation related to those fixtures. We also need to remove the asset from our books. It's an asset account, so as a normal debit balance. So to close it out, we credit the account. So we're going to credit fixtures, reducing the fixtures account by the cost basis, $8,900. So on August 31st, when we sell it, 8,900 credits to that account, closing it out to 0. We no longer own the fixtures, so we no longer want that as an asset. We don't balance. Do we need more debits or credits?
Debit.
Debits. And the amount of those debits needs to equal what? 1,116. We're going to debit loss on sale. Increasing the loss account. So something to remember is that book value is a calculation that we have in the balance sheet. It's not an account. The amount that you're debiting to our accumulated depreciation account is equal to the ending balance of your accumulated depreciation account. The amount that you're crediting to your asset account equals your cost basis. When you compare 8,900 to 4,984, it gives you your book value. And that's why you're comparing book value to cash proceeds to determine gain or loss on sale. Questions? Feeling okay?
Yeah.
Practice it. Practice calculating depreciation expense, and you should be okay with this. That's the second problem from chapter 7. We're going to do one problem from chapter 8 today and then call it a day, if that's okay with everyone.
You scroll down.
Yes. Is that good enough?
Yeah.
Okay.
Thank you.
No problem.
Professor Wade.
Yes, sir.
So we would, on the balance sheet, use loss of sale as a liability to balance it out, right?
Loss on sale is actually in the income statement. It's a non-operating item. So it's below operating income. And its loss is like, it's similar to an expense. So it reduces your net income. In the balance sheet, once you remove those two, it's reduced. The balance sheet total assets would be actually reduced by the book value.
Oh, okay. Thank you.
You're welcome. Okay. Any other questions on this problem? Or are you guys ready to move on to exercise 814A?
Move on.
Okay.
Professor Wei, in the accumulated depreciation is the ending balance of, can you tell me what it is?
So the balance as of August 31st is
The
4,984.
is the ending balance of what?
Here,
Yes. Ending
after you
balance,
remove
disposal.
after you
says
remove
in-
the asset, it equals 0.
Oh, but what do you write with the arrow? Ending balance, BB disposal? What?
Oh, ending balance before disposal.
Before disposal. Okay, thank you.
You're welcome. Okay, so For the first problem from chapter 8, it's a short-term notes payable problem. There's 3 journal entries you have to record. Recording of the note when they sign the note, so they take out the debt, an accrual of interest for the note, and then at the maturity of the note. So when they pay back the note and interest that's owed. We're going to do exercise 814A. A similar problem would be exercise 824B. It will be less intense than your homework problem for notes payable was, because I think there were a couple notes included in that one. It's just going to be one note that you're focusing on for this one. Quimby Sports Authority purchased inventory costing $30,000 by signing a 6% short-term 1-year note payable. The purchase occurred on July 31st, 2018. So July 31st is the date that this note starts accruing interest. Quimby pays annual interest each year on July 31st. Journalize the company's purchase of inventory, accrual of interest expense on April 30th, 2019. So that's going to be their year end. And payment of the note plus interest on July 31st, 2019. So what I did here down below, we're going to get to the journal entry in a second, but what I did here was just kind of drew their year ends. So the beginning of their fiscal year is May 1st. So this would be year 1. And the end of their fiscal year is April 30th, 2019. They signed the note partial year through year 1, right? So I'm just going to say right here, July 31st, 2018 is when they established that notes payable. That 1-year note goes from July 31st until June 30th, 2019. So this note is signed in 1 year and then going to be paid back in the following year, their fiscal year. Year 2 starts on May 1st, 2019 and ends on April 30th, 2020. So I'm just showing you that there's 2 fiscal years that are involved here. The 1-year note goes from July 31st, 2018 until June 30th, 2019. The first journal entry that you're recording is to record the purchase of inventory when we signed a note. So what will we debit on July 31st, 2018?
Inventory.
We're gonna debit inventory because that's what we received, right? When we sign this note, we increase inventory for what value?
30,000.
30,000. That's how much inventory cost. We're gonna credit which account?
Note payable.
Notes payable. And we're gonna credit notes payable, increasing notes payable for what value?
30,000.
30,000, principal only, right? The amount borrowed. So in our notes payable account, which is a liability account, so it has a normal credit balance. On July 31st, 2018, we established our notes payable account, 30,000. The only thing into or out of the notes payable account is principal, the amount borrowed. Part B, we need to record the accrual of interest on April 30th, 2019, which is the company's fiscal year end. So we know that 6% is the interest that's charged annually. This is our annual percentage rate. Have we had this note outstanding for an entire year yet? We signed the note on July 31st, 2018. So interest started accruing on July 31st, 2018. And year end for this company is April 30th, 2019. So between
Not the whole year.
between July 31st and April 30th, it hasn't been an entire year. It's been a portion of a year. And I did a little diagram for you, 9 months. So August, September, October, November, December, January, February, March, and April. Fingers work too. We need to calculate our partial period interest expense. So the amount of interest expense that we've incurred for their year. We're going to take our principal, which is the amount borrowed, $30,000, times interest rate, which is an annual interest rate, 6% per year, times the number of months outstanding during the current year, divided by 12 months per year. So we had this note outstanding for 9 months divided by 12 months per year. So 3/4 of a year. What amount of interest is incurred during fiscal year ended April 30th, 2019?
1,350.
1,350. So on April 30th, 2019, What do we need to debit and what do we need to credit?
Do we need to debit notes payable?
No, but thank you for saying that. Notes payable is not involved with the accrual of interest.
Interest expense.
We need to
Mhm.
record interest expenses incurred, so debit interest expense.
And credit interest payable.
Increasing interest expense for 1,350, the amount that's incurred, and credit interest payable for those 9 months worth of interest that we owe as of April 30th, 2019. So we will have another payable account that we're looking at. Interest payable, which is the liability account. And as of April 30th, 2019, we owe $1,350 in interest.
Professor Wei, when should I use interest expense, debit, and cash credit?
When you pay it. So if you are paying the interest that's been incurred, then you're going to debit interest expense and credit cash. When you
Uh-huh.
when you incur interest but you don't pay it on that date, you credit interest payable instead.
In this case, I pay it before, right?
You're going to
The
pay it
interest payable?
after. So if you notice
Oh.
here, it says the annual interest is paid on July 31st.
Okay, so if I pay it in the same month, it's going to be cash, right? If I pay it after, it's payable. Okay,
Correct.
because I was kind of confused on those two, when it's cash or when it's payable.
Yep. If you're paying it on that date, it's cash. And that's a common one for people to get confused.
Okay, thank you.
Payables are usually confusing. For the last part, the payment of the note payable on July 31st. So maturity of the note. We will have several debits, right? We're going to have 3 debits and 1 credit on the maturity date of that note. So that note has been outstanding now an entire year. We're paying back, if I knew how to write correctly, sorry. We're paying back the note. So what's the first debit going to be? 2.
Notes payable.
Notes payable. So we're going to debit notes payable. Paying back the principal, right? Paying back the amount that we borrowed. So we're going to debit notes payable for 30,000, reducing the account to 0. On the maturity date. So that account closes to 0. What other account needs to close out to 0? Because we're going to pay it off.
Interest payable?
Interest payable.
Interest payable. So we're going to debit interest payable. Reducing interest payable, and interest payable was for those 9 months worth of interest. So that kind of just a hint. 1,350. So interest payable on July 31st of 2019 debited for $13.50, closing out that account to zero because now we're paying off that amount that we owe. The last debit is going to be to what account?
Interest
Interest
expense.
expense.
Interest expense. So I will debit interest expense, but we will need to calculate it. And from April 30th, 2019 to May 31st, 2019 to June 30th, 2019 to finally the maturity date. In year 2, we incurred 3 months worth of interest. So you'll do the calculation again, which is 30,000 borrowed times the 6% annual interest expense, or I'm sorry, annual interest rate times 3 months divided by 12 months per year.
450.
450. So in total, we've incurred 12 months worth of interest. The note was outstanding for the entire 12 months. But 9 months were in their fiscal year 1, and 3 months were in fiscal year 2. So we're separating the interest expense like that. What amount am I going to credit and what am I going to credit?
Cash.
We're going to credit cash, reducing cash for 30,000
31,000.
plus 1350 plus 450. So the amount of principal borrowed plus the interest incurred over the life of that note.
800.
31,800. Remember that you're not reversing interest expense, you're only reversing interest payable. Interest expense that you're recording on the maturity date relates to the second year's worth of interest incurred. So 3 months were incurred in year 2, $450 worth of interest was incurred. So that's what amount you're debiting to interest expense in year 2. What was that?
Just scroll down a little bit, please.
Yes.
Thank you.
Better?
Yeah, that's better. Thank you.
Questions?
No.
Okay, I'm going to pause the recording.